So we all got our favorite banks, and there's a possibility that our favorite banks might just fail one day because of a bank run.
Triggering a run on the bank, which is me.
Which is a situation where banks don't have enough cash to return to their depositors. So the reason for this is because of fractional reserve banking. And this is where banks can create loans from money that depositors put into the bank, allowing the bank to free up capital for lending, which then turns and expands the economy because most businesses run on debt.
What debt?
So let's talk about what fractional reserve banking is, the benefit it brings, the downsides, and how we can protect ourselves in the event that a bank fails. So imagine today you walk into a bank and open a bank account. So in the T&Cs, you allow the bank to use a portion of your deposits as loans to other customers. And in return, the bank pays you some interest. So depending on the interest rates, it can be anywhere between 0.05% all the way to 2%. So as said, when you deposit your money into the savings account, the bank can then use a portion of your money as capital to fund a loan that someone else is taking. So for example, if you deposit $1,000 into your savings account and get a 2% interest on your money, the bank might in turn use up to 90% of your money to fund a loan. So in this case, John can come in and borrow $900 that he needs to purchase a laptop for work. So let's say John takes $900 of loan and goes to the computer store, purchases a new laptop for $900. Now the computer shop can take that $900 and deposit it back into the bank, which earns them a 2% interest, but now the bank can loan out another $810 to someone else, and this cycle can continue. So just with these transactions, the bank has effectively created $1,710 from the $1,000 that was originally deposited, which means that the system now has $2,710. So now you might be asking, how can this be? Because it sounds like a huge scam.
It's a scam.
It is not a scam.
But there are some benefits to this system as compared to a 100% reserve banking system. So the 100% reserve banking system will not enable banks to churn out loans, which means that money won't get spent and the money stays stagnant in the bank like a safety deposit box, and the bank might actually end up charging you for holding your money. So with a fractional reserve banking system, money can constantly get loaned out, helping people build businesses, buy houses, or even invest, which ultimately expands the economy much more, which then creates more jobs as well. So the next benefit here is mainly for the depositors, because when more money gets lent out, this means that the bank can pay more interest. So with more interest, this will help you grow your money faster without letting it fade away due to inflation. But then like everything in life, there is also a downside to fractional reserve banking. So like recently we saw the event with Silicon Valley Bank, which was a good example of how a bank run happens. So one of the biggest downside of fractional reserve banking is the dependency on things being normal. But since 2019, we have come to understand that there is no such thing as being normal because the world is changing every single day.
I don't know what normal is anymore.
So if things were staying status quo, people deposit money, people borrow money, everything goes well. But when either side fails, then the banks will have a big problem on their hands. So in the case of Silicon Valley Bank, the bank was operating as usual. But some depositors wanted to withdraw their funds because the rates offered were not as good as the other banks. So now imagine if this happened on a large scale. So let's say if a family went to DBS, for example, to withdraw their funds, and then your friends and their families do the same thing. So if enough people do the same thing of going to the bank and withdrawing their funds, DBS will probably have a big problem on hand, and they will have to put out a notice to say that they might need time to provide these funds. So when this happens, it creates more panic and more people start to do the same, which then leads to a bank run. And it will come a point where there will be people who are not able to get their funds out because most of the money that were deposited were either still out on loan or they were created digitally. So now one question you might have is that, don't you have SDIC? So SDIC, or Singapore Deposit Insurance Corporation, is an organization that protects depositors like you and me for up to $75,000 in the event that a bank closes down or is unable to make payment. So this is something very important to take note of, but by and large, most banks that are operating in Singapore are covered by SDIC, which means that your deposits will be covered if one of the banks in Singapore fails. So this might sound awesome and good, but there's a caveat to it, which is the covered amount is only up to $75,000. So if your bank account have a total of $75,001, this means that you only receive $75,000 back. But if your total balance is lower than $75,000, then you will likely receive the whole sum. So from the shutting down of Silicon Valley Bank, we can learn that some companies have placed too much trust just in one bank itself. And if possible, I think it'll be good to spread your money across different banks, which will give you some coverage in the event that your favorite bank closes down and you won't lose all your hard-earned money. So this brings us to the end of today's video. Don't forget to like and subscribe, and as always, stay safe, invest safe, and I'll see you in the next one.